Hey guys, hey, it's Daniel Lehman with the Lehman Group. Hey, so obviously a lot of talk about how rates have gone up and how affordability is down. The biggest question that I get on a consistent basis is, does it make sense to buy now or does it make sense to buy later? And that question is really a question that has to be answered by your personal goals, your personal financial situation, and a big part of that is your time horizon. But there are a lot of cases being made against buying now. I want to make a couple cases for buying now because I think they're underrepresented. So take a look. I'm going to share my screen with you and let me know what you think. All right, so like I mentioned, I'm going to make a case for buying a home in today's market, not the case. I'm going to make a case. I put it in a PowerPoint just because I wanted to organize my thoughts and hopefully stay on track because there's a large chance of me getting off track if I don't. But the two things that I really want to talk about, the two elements are inflation, and I want to give you an idea of what, in my mind, I call the acquisition scenario. I want to put some real solid numbers behind the last 12 months and going forward and really try to help explain, again, not that you should be buying or that you shouldn't be buying, just giving you data. So first things first, let's talk about inflation. Inflation is defined as the persistent increase in the level of prices, so prices going up. But it's more, for me, related to the power of money. If you have a dollar, how much does that borrow? So a persistent decline in the purchasing power of money. And what's funny about this is anytime rates go up, I always run into people and they're like, well, when I bought my first home, rates were at 14%. It never fails. I always run into that. And my question, and you guys probably have as well, my question always, my follow-up question is, well, okay, well, how much did you buy the house for though? And that's what's all, and they'll be like, well, I bought it, and then you realize that they bought it back in the day when prices were much less. So last time rates were 14%, the average home price, this was in 1984, the average home price was also $99,000. And obviously nowadays we're up above 500,000 average. That's not even taking into account any regional stuff. This is nationwide. So the reality is that as consumer prices and as inflation has continued, this is a consumer price index. That's how the government tracks inflation. As inflation has gone up, you can see that housing has tracked right alongside of it. So the reality is that homes are not necessarily getting more valuable. The dollars are getting less valuable. Your dollars in your pocket are getting less valuable. So that has to do with a number of things. Partially it has to do with money printing. Partially it has to do with supply and demand issues. There are a number of things that go into inflation, but the reality is that over time your dollars are getting less valuable. So how do you hedge against inflation? You buy scarce assets. You buy assets. So the problem with the dollar right now is when the government prints money, there's more and more and more and more dollars, which whittles down the value of the dollars that exist now. That's why people buy gold. That's why people buy silver. That's why people buy, in today's market, they buy Bitcoin. Bitcoin, there's only going to be 21 million of them. So there's a scarce asset. And that's the reason why people buy real estate as well, is because it's a scarce asset. So how do you hedge against inflation? This is a chart of your monthly rents, just to kind of drive that point home. Here's monthly rents since 1940, your average monthly rent. In 1990, just to kind of give you 30 years ago, and again, this is nationwide. So 30 years ago, rents were just under $450 a month average nationwide. Today, they're almost $1,200. That's a 266% increase in rents over the last 30 years. So if I take that increase and I project it forward, this isn't even factoring in any acceleration of inflation. So if inflation accelerates at all, this number is going to be higher. But if I take the same inflation from 1990 to now and I project that forward, average rents nationwide are going to be $3,173. Again, that's not factoring in your local region. So when you think about it, how much is rent in your current area now? And what does that rent become if rents increase 266%? So if you're paying much higher than the national average and you increase that, if you multiply it by 2.66 or you increase it by 266%, what does that rent become going forward? There's your opportunity cost and your risk on the not buying side. What if you were to buy today? How does inflation affect you if you control the asset? If you buy that scarce asset, how do home prices look in 30 years? And if you rent, what's your housing expense? We've talked about that. But if you buy, what's your housing expense? In 30 years, you will have paid down at least a very large portion of a 30-year fixed. So and the other thing to consider about that, if I go back real quick, is this green line here also represents your housing expense. If someone was to buy back then and they had a mortgage for that much, their mortgage isn't changing with inflation. It's staying down. So you're holding your expense load down. You're controlling one of your biggest expenses, which is your housing expense. And then what can you do? In essence, even if you can buy now and it's higher than you could rent for, as rents go up with inflation, the difference between market rents and your mortgage, which stays the same, continues to increase. So in a lot of cases, like my first property that I bought, my mortgage payments stayed the same, rents go up a ton, and you can rent that property out and make the difference and keep that inflation hedge and even make a return on it in addition to everything else. So what's your housing expense if you rent? What's your housing expense if you buy? And most importantly, how does this affect your net worth or your ability to retire? If you fast forward and you're not, and your house prices keep going up and up and up and up, and your income or your ability to produce an income stays the same, obviously that's problematic and you're going to run into an impasse. So if you can control that, that's a definite important thing with inflation in the news and inflation being at the forefront, something you want to really consider. So you may say, okay, fine, inflation, but this is a 30-year time span. So we're talking about a much shorter time span. Let's talk about affordability in the current market as it relates to, like, I got it. You sold me. I'm going to buy it at some point. But, what does it look like now? So I want to do the case for acquisition for you and just give you a scenario. So again, this isn't to tell you to do one thing or another. It's just to give you a scenario that could come to pass as a case for potentially buying. So I'm going to look at one property in one market. I'm going to look at three different or one property, one area, and three markets. First, I'm going to look at early 2022. So earlier this year. It was obviously a seller's market, 3.5% 30-year fixed, really good rates. I'm going to look at right now, late 2022, as I'm filming this or as I'm taping this, it's 11/7, I think. It's November 2022. It's a buyer's market, rates in the high sixes, mid sixes, 6.5 30-year fixed. And then the answer to your question, or the answer to the question, is going to come from, do I buy now, right? Late 22, or do I just wait for prices to drop, or do I wait for rates to drop? So I just pulled a random listing, random neighborhood, Oceanside, California. The price point was $750,000, super high competition in early 2022. It was definitely a seller's market. We were getting no concessions. You almost had to give up your firstborn child to get your offer accepted. So you were stuck paying the fees, escrow, title, notary, taxes, insurance, all that stuff were out of pocket for the buyer. It was very difficult. 30 offers, 50 offers. If you were a VA buyer, good luck to you. If you've got zero down and no way to make up a difference in appraisal, it was very difficult. That being said, it was very difficult because rates were pretty good. So I'm just using a conventional, this math works with FHA and VA also, but I'm just using a conventional loan as my example. So $750,000 price point, $150,000 down, that's 20% down. That's a $600,000 loan amount. 3.5% rate gives you just under $2,700 a month payment, but you are stuck paying your closing costs. So you're putting $150 down plus $12,000 paid by you. Now, fast forward, rates go up, market shifts. All of a sudden, we're getting price reductions. So in that neighborhood with that house that I showed you, there was generally speaking, the market, the kind of average price point went down about $50,000. So that's what I'm using. 700,000 price point, much lower competition because rates were up, and you could definitely get seller concessions. In fact, it's super, super typical to not only get your taxes and fees paid, but potentially get some cash. And a lot of the buyers that we're working with are getting additional funds to buy down the rate, because the sellers, in lieu of doing further buy downs or further reductions in price, are finding utility in buying down the rate to make the buyer's payment more comfortable. So let's take a look at late 22. Like if you were to buy now, here's an example of what that might look like. You're putting a little bit less down because the sales price is less. So 140,000. So it's a 560 loan amount. So you actually owe 40,000 less, but your rate is 6.5%. So your payment is an increase of $845 a month from earlier this year. And this is the definition. This is what, when we talk about affordability or the change in affordability, this is what we're running into. I think the biggest problem that people are having right now is they're focusing heavily on this, and they should focus on the increase. They should focus on it, but they should focus on this and they should not stop here. What you have to do is consider what comes next, right? So 845 increase. There are some upsides though, right? $22,000 less in cash to close because you're putting 10,000 less down, and you could get that 12,000 closing costs paid by the seller. In addition, you have $40,000 less to pay off over the life of the loan because your sales price went down by 50,000. So you're buying the same property for $50,000 less. Where people stop here is with this loan. And what you have to do in these markets is zoom out and look at a much broader strategy. So this is the second half of this strategy. Based on what Fannie Mae is projecting, based on a slowing economy going into next year, most people are projecting, and I've done a video on this before as to why rates went up so quick and why rates should come down just as quick. This is not guaranteed. I have a word on this later that I'll kind of mention to you, but mortgage rates, Fannie Mae is projecting that rates fall to 4.5% in 2023. So what happens if you buy now and then you refinance? If Fannie Mae projections are correct, you've acquired the property for 50,000 less. So your loan amount's at 560, and then you refinance paying that 6.5% rate down to what Fannie Mae is saying, that 4.5% rate. All of a sudden your payment goes down to $2,837, which is only an increase of $143 a month from the time when you'd be paying $750, paying all your closing costs and all that stuff. So that's much more in line. The reduction in payment, even though the rate's a little bit higher than the lows, when you think about that purchase with a refinance connected to that, it gets a lot more in line. Now, you may be thinking, and the next thought would be, okay, well, look, why don't I just wait until rates come down from here? The problem with that thinking, the why not wait until rates drop thinking, is when rates drop, it's back to a seller's market. There's still a fundamental problem with supply and demand. There's still not a lot of people selling their houses because they've got those low rates and they've got all the equity. There aren't massive problems. There could be massive problems in the future. Again, I'm not making the case that this is definitely the way that things are going to work out. I'm just saying that if rates drop and things stay the same, it's back to a seller's market. Competition comes back. Seller concessions go away. And you've already missed the low rates. So now 20% down, instead of on 560, you're down to a 4.5% rate on the 600,000 because of the increased sales price again. You're also, because of that, you're borrowing more. So you're up to $3,040. So you're actually $346 a month more from the lows as opposed to $143. And on top of that, it's a $62,000 swing in cash because you've got to come in with $10,000 additional down plus $12,000 of your own costs, because when the market swings back up, sellers aren't going to be paying that stuff. And you owe $40,000 more for the life of the loan. So again, to summarize, rates in the 2% and 3% range are probably gone for good. They probably should have never been that low in the first place. The question is, starting now, what do you do? Do you buy now? Do you wait now? Again, it depends on your scenarios, but hopefully this opens your eyes to kind of the different potential solutions that exist. Now, just because I want to be super, super, super careful, I could be completely wrong. The market could totally tank. Unemployment could become a massive issue. There are all these things that are super problematic. So you have to look at your financial situation, look at your time horizon, look at your cash position. And this example is not advice. It's just meant to counterbalance and give you information so you can kind of see what a zoomed out plan looks like, as opposed to just looking at the transaction and rates on a very on a superficial basis. The other thing that I want to note is be careful not to rely on a refinance. Don't put yourself in a precarious situation with a adjustable rate mortgage or with a much higher payment than you're comfortable with and just bank on a refi. Because even if market rates do come down, conventional refinances, for example, usually require an appraisal. So if values don't drop and you don't have cash available, at minimum, that may change your plan and it may screw up your plan. And you want to be really careful of that. I want to also mention that with VA and FHA, it becomes less of a problem. So if you're VA and FHA eligible, or you're doing a VA or an FHA transaction, there are streamline refinance loans that don't require their streamlined loans don't require a appraisal in order to refinance. So it's a little bit less of an issue when you're going VA and FHA. No appraisal, no income, so no income documentation requirements. They figure if you've been paying at a higher rate, you'll keep paying at a lower rate, and they'll let you do that streamlined loan. So just a couple things to consider. So again, hopefully this helps you guys just get another viewpoint. You look at the long-term effects of inflation and the benefit of home ownership, and you start to realize, looking back years, if you would have got your foot in the door, even if it's not the perfect property, if you bought something that was affordable, let inflation work for you, and then take those gains and roll it into something later, if you don't get your foot in the door, it gets really hard and you can end up chasing the market for a long period of time. And that becomes tough. So that's kind of the long-term, the longer time window version of the buy versus wait. The shorter term is just make sure that you try to zoom out a little bit. 2s and 3s are gone probably. So now, because we're at a high, does it make sense to buy now, lock in that purchase price? I didn't factor in the costs of a refi because I figure the costs of a refi are kind of offset by the fact that if you weren't to do that, you'd have costs of renting that just have no benefit at all. So those are I didn't get too into that, but hopefully that helps. If you have any questions, please let me know. If you have any comments, or if you disagree or you think this is not the right way to look at things, always let me know, because I'm always open and interested in other people's thoughts on it, or where I may be going wrong. Thanks so much for tuning in, and we'll see you next time.